I just saved hundreds of pounds moving my SIP to trading 2-on-2. So in this video, I'll show you the transfer process, explain why I did it, and then walk you through my portfolio, explaining why I hold what I do. So I had a few old workplace pensions, like I'm sure many of you do, and I wanted to consolidate them together. I've done a few videos in the past on the importance of reviewing and combining old workplace pensions, but essentially most of them were in suboptimal funds, and a few of them had really hefty fees. This was in October of last year, and at that time, trading 2-on-2 didn't have a SIP available. So I decided to consolidate them into Hargreaves Lansdown. And while it's not the cheapest of platforms, it covers all bases in terms of a variety of investments. So it means I could invest into single stocks as well as ETFs. The process of transferring them is actually relatively easy. All you need is your account number from your previous scheme, and then you do it all through the new provider. If the new provider is able to hold the same investment than you held before, then you can transfer in what's known as in specie, which essentially means you can transfer the stock, so you don't need to sell it. And that's exactly what I was able to do transferring from Hargreaves Lansdown to trading 2-on-2. But before that, when I was consolidating them, I had to transfer them as cash because the old workplace pensions were very unique and niche funds. And the reason this is important is to set your expectations. So if you're moving to a new provider that can't hold the same investments and they all need to be transferred as cash, because these transfers can take a long time, you need to accept that for a period of time, your money will be out of the market. Of course, in the grand scheme, if you're holding a pension for 30 years and your money is out of the market for a couple of months, it's not going to make the biggest of differences, but you just need to be aware. But having said that, while the process of these transfers is relatively straightforward, the most frustrating thing is that time. I first requested my transfer from Hargreaves Lansdown on the 3rd of June, and it only completed on the 10th of August. I was lucky in that all but one of the 15 investments that I had were able to be transferred as stock, so I had very little money out of the market. But one of the biggest reasons I wanted to transfer from Hargreaves to trading 2-on-2 was simply fees. Hargreaves Lansdown charged 0.35% as an annual charge on their SIP, and this has been reduced down from 0.45%. If you hold just ETFs, investment trusts, and single stocks, then there is a cap of £150 per year. And that means once your portfolio roughly crosses £42,800, that percentage will gradually come down. But that's still money being taken from your portfolio that isn't being compounded every year. And then on top of that, there's dealing fees, again, which have been recently reduced down to £6.95. And that's on both directions, buying and selling. So for every stock, you've essentially got £14 of dealing fees. And again, if you've got a larger portfolio and you're dealing in larger amounts, then you're not really going to notice this. But it can add up if you're making regular trades. And then on top of that, again, you've got FX dealing fees, which for the first £10,000 of a deal is 0.99%. I was transferring a portfolio around £60,000, which definitely isn't big enough to warrant needing a platform like this and justifying the charges. So if you're in a similar position, then it's definitely worthwhile reviewing the costs. So now onto the portfolio itself. And while I've touched on this in the past, I have had quite a few comments asking me to break down why I'm holding what I do. So I'm going to give you a high level overview and run through my reasons about why I've chosen each investment. Before I do though, this has to come with a lot of caveats. There's no right answer of these. All of these are just my personal opinion. None of this is financial advice. And while I might be able to justify investing into a specific stock or investment, that might not be suitable for you. In terms of time horizon, I'm 36 now. The earliest I can access this pension right now is 57, although that could increase later down the line. So we're talking at least 20 years. I'm also what I would call a more active style investor. I like putting the time and effort into the research and delving into the fundamentals of a company. I'm willing to take on the risk of underperforming the market because that's just my style. It's also what I do for a living. I'm a full-time content creator looking at investments and personal finance on a daily basis. I also worked in the asset management industry for 10 years. However, I'm definitely not naive enough to think I can beat the market every year. This is just my preferred style of investing, and I take on that risk. So the portfolio is split into two parts. I've got an ETF part, and I've got some single stocks. We'll start with the ETF part. This is what I call my DIY global ETF. So instead of just picking one ETF that covers the whole world, I decided to split this into 6 separate ETFs covering different regions, and then I was able to select my own weights. Part of this came about because I was slightly uncomfortable with such a high weight into the USA in a normal global ETF. But it also then meant I could spread that into other areas, which I felt had more potential. So my process to create this is starting with what's already in a global ETF. And I used Vanguard's VWRP global ETF to do this. And they already split out this by a number of different regions. the biggest one being North America, so combining essentially USA and Canada. It then also gives you splits for Europe, Pacific, and emerging markets. And if you wanted to, you could just create a portfolio using those 4 regions. But if we scroll down to the allocation by country, because Japan and then United Kingdom are the next 2 biggest countries, I preferred to take those out of their equivalent region and do those separately. Hence why you'll see I've got a FTSE Developed Europe excluding the UK fund, and then the same with the FTSE Developed Asia Pacific excluding Japan fund. And then I've done FTSE 100 separately and Japan separately. I mean, you could keep taking this a step further. With how much Taiwan has grown over the last year, you could make the case of doing Taiwan separately as well. The same with China. It really just depends on how much flexibility you want. So having looked at those regions, I then decided what weights I wanted in my DIY portfolio. And being quite an aggressive investor, I decided to roughly half the allocation to North America to then spread elsewhere. So I increased Japan to 10%, I increased the FTSE 100 to 10%, developed Europe was up to 12%, emerging markets was probably the biggest jump, going up to 25%, and then developed Asia at 11%. North America was still the biggest weighting, it was just dramatically reduced from where it was before. Just one thing to note on these performance percentages is don't read too much into these here, because this is from when it transferred into Trading 212, not from when I bought it back in October. Frustratingly, when I did the transfer, there was no option to select a starting price. I know sometimes when you transfer an ISA, you're able to select what you bought it at so you can maintain that performance data. This is just from literally a few weeks ago. So far, I haven't done any rebalancing across these ETFs. I'm willing to let these run a little bit more. The only thing I have done is take a little bit more out of North America because there were some specific single stocks I wanted to buy, which we'll come on to next. So alongside those 6 ETFs, I also hold a number of individual investments. And when I first started this portfolio, the idea was that I would have around 60 to 65% of it in those passive ETFs. But as you can roughly see here, the portfolio has now moved closer to a roughly 50-50 split. But that's just because of how these investments have performed since I invested into them last October. When I first started the portfolio, I had 6 companies I wanted to have exposure to. I prefer more of a top-down style approach to investing. So that means I'd like to look at a specific theme and then drill down into the individual company. So I selected 3 themes that over the next 10 to 20 years, I was fairly confident would be a big driver in performance. Those were defense, AI infrastructure, and nuclear power. For defense, I think most people would agree for the next 10 years at least, defense budgets around the world are only going to go in one direction. So for that, I picked BAE Systems and RTX, what used to be known as Raytheon. Also got some exposure there from Rolls-Royce, but I'll come back to them. And then for AI infrastructure specifically, this was looking at the bits that support AI. So in a so-called AI gold rush, the ones that I think will be making the most money is the ones supplying the shovels. So I first picked the Dutch company ASML, who've been on an amazing run over the last couple of years, but they make a very specific machine that actually makes the chips and makes the semiconductors. And then alongside that, I picked Equinix, which is a data center real estate investment trust. And with this one, it's thinking about diversifying the revenue streams from AI, because whatever happens on the front end with AI, those data centers are still going to have to pay the rent to the owner of the building. And then with nuclear, I've got Cameco and Rolls-Royce. So Rolls-Royce is what I like to call a trifecta exposure. So they've got exposure in civilian aircraft, they've got it in military aircraft, and now more recently, they've got it into nuclear, especially with their small modular reactor, SMRs. And this follows on from that AI point because all those data centers need so much power to run. And then combined with wanting to have more greener energy sources, nuclear is going to have a massive part to play there. And I see us moving away from the older style nuclear power plants that take years to get approval, let alone built. Now with these small modular reactors, they can be built on site and at much quicker pace. But of course, this also overlaps with the defense point because Rolls-Royce is also involved with military aviation too. With Cameco, this is thinking about the element that actually fuels nuclear power. And one of the main ones is uranium. And Cameco is one of the world's largest uranium producers. So the themes themselves, I think, are fairly straightforward and almost obvious. All I've done is tried to come at it from slightly different angles and just had that conviction to pick these 6 companies. And then you'll also notice I've got 3 other stocks in Micron, Oracle, and SanDisk. And these are what I would call more opportunistic plays, especially with the likes of Micron and SanDisk. These have been on incredible runs over the last couple of years. And it's been that point about wanting to get in, but it feels too expensive and you're waiting for a dip that never comes. And then finally, early this year, we got quite a substantial dip that I felt was worth the risk of now getting into the market. But I've done this at smaller amounts than I've done across the other investments. Also, being 3 US stocks, I've taken the money from my North American ETF to put into these. So actually, when we looked at that North American ETF, although it's reduced a lot in exposure, because I've got some quite high conviction plays in US companies, actually my US exposure is higher than it first might seem. The same could also be said of the UK as well, because 6.65% of the fund is in the FTSE 100, and then I've also got the likes of BAE Systems and Rolls-Royce. But I'm happy with that slightly higher exposure. It's a home bias, and a lot of the companies in the FTSE 100 are your consumer staples, financials, and I'm happy holding them right now. So this portfolio has really evolved, and I'm definitely not looking at making any other investments anytime soon. I'm just gonna leave this to do its thing now. And I think that can be the biggest risk of creating a portfolio like this, is that you can be constantly tinkering. But like I said at the start, this is what I feel works for me, and I can justify each of these investments. And at the end of the day, I can't touch this for at least 20 years. Yes, of course I can change the investments, but it's not like I can panic and suddenly want to withdraw the money. So even if one of these companies does crash 30, even 40%, I would hope that I've got the time horizon for it to recover. And what I've ended up with this portfolio is that I've been very fortunate in that a lot of the single stocks have hugely outperformed the market. But it now means that some of my biggest holdings are in individual companies. So really this type of portfolio suits someone who likes looking into the detail, likes making those active decisions, and are not going to be worried that if a stock does fall 20, 30, even 40%, you can handle that unrealized loss. And if all that sounds way too complicated and too much stress and work, well, then that's what a global ETF is literally for, because it's the most hands-off, set and forget investment. And for a lot of people, having that in your SIP is a great choice. So let me know in the comments what you're doing with your SIP. And if you're at the stage where you're thinking about drawing from your investments, you may have considered dividend ETFs. If that's the case, then watch this video next. Thanks for watching. I'll see you in the next one.